It is Tuesday, January 27th, 2026, and if you've been staring at the auto sector feed today, you are seeing a sea of green with one glaring, very expensive red outlier.
Yeah.
We are looking at a market that is fundamentally rethinking what a car company actually is.
It's a fascinating session.
Yeah.
Usually, the sector moves in a pack. Rates go down, autos go up. But today, we are seeing a decoupling.
A real split.
We're seeing the market reward execution over promises, which is, well, it's a bit of a shift from the last few years.
Right, and to make sense of this, we aren't just going to read headlines. We're running a full sector analysis based on the stock screener for the big three, General Motors, Ford, and Tesla. We're going to strip down the technicals, the fundamentals, and the story driving the price action for each one.
And we should probably clarify the mission here. We aren't just looking for the highest number. We're looking for the disconnects.
Exactly.
When the price action disagrees with the news or when the valuation defies gravity, that's where the real insight is.
And before we get into the tickers, just a quick standard disclaimer for everyone listening. We're analyzing data and market psychology here. We are educators, not financial advisors.
Right.
This conversation is for informational and entertainment purposes only. Please don't take this as investment advice.
Always good to keep the lawyers happy.
So I want to try something a little different with the numbers today. Let's call it the paper money math challenge.
Okay, I like it.
We're going to assume you, the listener, had $5,000 burning a hole in your pocket exactly 1 year ago today. We'll track where that money would be right now for each of these three giants.
Which is a brutal but necessary way to measure opportunity cost. Percentages are abstract, cash balances are reality.
Let's start with the absolute monster of the day. General Motors, ticker GM. I'm looking at the screener, and the price action is just aggressive.
Aggressive is putting it mildly. GM is the breakout star of the session. It's trading at $86.38. That is up $6.95 in a single day. You're looking at an 8.75% move for a legacy OEM. That's huge.
And this isn't a recovery bounce from a low, is it? This is pushing into brand new territory.
Correct. We just smashed the 52-week high. The previous ceiling was 85.18.
Right.
Breaking that level on high volume, and the relative volume is 2.67 today, that usually signals that the institutions are piling in, not just retail traders.
Looking at the technicals, it's trading way, way above the moving averages. I mean, it's 42% above the 200-day SMA.
It is.
Usually when I see a large cap stock that extended, I start looking for a pullback. Is the chart overheating?
It's hot, but I wouldn't say it's irrational. The RSI is sitting at 64.32. It's approaching that overbought 70 level. But in a breakout like this, RSI can stay elevated for weeks.
Momentum breeds momentum.
Exactly. And what's interesting is that this technical breakout is happening despite what looks like a messy earnings report on paper.
That was the confusing part. They released Q4 numbers, and there's a net loss. They took a $7.2 billion charge related to the EV shift.
Yeah.
Normally, a $7 billion loss just tanks a stock. Why is Wall Street shearing this?
Because the market loves a kitchen sink quarter when the forward guidance is good. That $7 billion is a non-cash write-down. It's accounting cleanup.
Oh,
They're clearing the decks. But the real fuel for this rally isn't the earnings beat, it's the capital allocation.
the buybacks.
A massive buybacks. A $6 billion authorization.
There is always this debate, though. You have critics saying, why aren't you pouring that $6 billion into R&D? Why are you shrinking the float instead of building better batteries?
That's the bear case, sure.
Is GM mortgaging the future to pop the stock today?
Well, look at the counterargument. GM is generating so much cash from their combustion truck business that they can fund the EV transition and buy back shares. It's a flex. They're telling the market, we are undervalued, so we are buying ourselves. Plus, they hike the dividend 20% to 18 cents.
That confidence seems to be outweighing the macro risks. I noticed CEO Mary Barra flagged tariffs as a potential $3 billion headwind.
And the market just shrugged it off. That's the most bullish signal you can get.
Yeah.
When a CEO says government policy might cost us $3 billion and the stock goes up 9%, investors are essentially saying, we think your pricing power is strong enough to eat that cost.
Let's talk valuation then. At $86, are we paying a premium?
This is the wildest part. Even at an all-time high, the forward PE is 6.23. Six. You can barely find a bank trading that cheap, let alone a tech-forward auto company. But look at the PEG ratio, 0.74.
And anything under 1 is usually considered undervalued relative to growth. So despite the chart looking vertical, the math says it's still cheap.
It implies that the earnings growth is outpacing the share price appreciation. It's a value stock masquerading as a momentum stock.
Okay, let's apply the paper money math. I had $5,000 1 year ago. I ignored the legacy auto is dead headlines and bought GM. How did I do?
You did phenomenally well. The perf year metric is up 60.23%. So 12 months ago, you would have bought in around $53.91.
Okay.
That $5,000 got you roughly 92 shares.
And today?
Today, those 92 shares are worth over $8,000. You made a profit of roughly $3,011.
A 60% return on a blue chip stock in 1 year. I mean, that beats the S&P. It beats most tech funds.
It's a reminder that boring companies with cash flow can absolutely rip when sentiment shifts.
All right, moving on to the second member of the big three, Ford Motor Company, ticker F. They're also green, trading at $13.93, up about 3.5%. But the narrative here feels different. GM is the breakout, but Ford feels like the pivot.
It's a pivot and a yield story. Technically, Ford is looking healthy. It's up nearly 40% over the last year, trading comfortably above its 200-day moving average. But you're right, the catalyst isn't just selling trucks.
It's the Ford Energy news.
It's the news about Ford Energy.
This caught my eye. They appointed Lisa Drake as president of this new unit, and they aren't just selling home chargers. They are taking over a plant in Kentucky to focus on utility-scale storage.
This is significant because it addresses the cyclicality of the car business. Cars are boom and bust. Energy storage grid stabilization is a constant demand.
A smart hedge.
A very smart hedge. By repurposing that plant, they're trying to monetize their battery supply chain for something other than vehicles.
Speaking of supply chains, there's a spicy rumor floating around the screener newsfeed. Ford in talks with BYD.
This is the geopolitical tightrope walk of the year. Reports are that Ford is talking to BYD, the Chinese EV giant, about battery partnerships for their overseas plants.
Given the tariff situation we just mentioned with GM, isn't partnering with the Chinese firm risky?
Politically, extremely, economically. It might be necessary. BYD has the cost advantage.
Right.
If Ford wants to be profitable in Europe or Asia, they might need BYD's tech inside their chassis. It's a pragmatic move.
Meanwhile, they are still dealing with the legacy headaches. I see a recall alert for 119,000 vehicles. Engine block heaters.
It's the recurring nightmare for Ford. Warranty costs and recalls have plagued them for years. It's a drag on margins. But investors seem to be forgiving it today because of the value proposition.
The dividend.
Right. Ford is paying a yield of 4.88%.
Almost 5%.
In a market where you might be worried about volatility, getting paid 5% just to wait is attractive. It puts a floor under the stock price. The PE is higher than GM's, sitting around 11.9, but that yield attracts a different class of investor.
So let's check the paper money math. $5,000 into Ford 1 year ago.
The stock is up 39.86% over the last year. So your entry price would have been right under $10, $9.96 roughly.
So I could pick up a lot of shares.
You picked up 502 shares, and it paid off. You've gained just under $2,000 in capital appreciation, $1,993 to be exact.
So a total value of almost $7,000.
$6,993.
Yes.
Plus the dividends you collected along the way. It's a solid double. Not the home run of GM, but very respectable.
Now we have to talk about the outlier. The stock that usually sucks all the oxygen out of the room. Tesla. Ticker TSLA.
The volatile giant.
It is the only one of the three in the red today. Down about 1% to $430.90. And looking at the screener, the volatility metrics are they're in a different league.
The average true range, the ATR, is 14.55. That means on a standard Tuesday, Tesla swings $14. That's massive. But right now, the stock just looks tired. It's trading below its 20-day and 50-day moving averages.
It feels like it's holding its breath. We have earnings coming out tomorrow, Wednesday the 28th. And the headlines leading up to this are painting a picture of wartime mode for Musk.
It's a pivot point. Sales in Europe fell 20%. Brand value metrics are down. If this were just a car company, the stock would be plummeting.
But it's holding over $400. Why?
Because the story has changed.
We've stopped talking about the Model Y and started talking exclusively about robotaxis and Optimus?
That's the entire investment thesis now. You aren't buying a car manufacturer. You're buying a call option on artificial general intelligence and robotics. That is the only way to justify the valuation.
Let's look at that valuation. We said GM has a PE of 6. What is Tesla trading at?
287.92.
That is a different galaxy.
It's a forward PE of 200. The PEG ratio is 34.8. Remember, GM was 0.7. You are paying a 34 times premium relative to growth.
Wow.
The market is pricing in a future where Tesla dominates not just roads, but labor.
But that makes the earnings call tomorrow terrifying, doesn't it? If they come out and say robo-taxes are delayed or AI progress is stalled, what supports a 287 PE?
Nothing. That's the risk. It's an air pocket. If the dream is deferred, the valuation has a long way to fall to meet the reality of the car business.
Okay, let's run the paper money math here, because I think this will surprise people who just read the fan blogs. $5,000 into Tesla 1 year ago.
This is the harsh reality of volatility. Despite all the noise, the perf year is only 5.98%.
6%. You would have made more money in a high-yield savings account.
Basically, you bought in around $406, you got about 12 shares. Today, you've made a profit of roughly $299. Total value.
Yeah.
$5,299.
So in the last 12 months, the boring GM investment outperformed the revolutionary Tesla investment by a factor of 10.
In the last 12 months, yes. But, and this is a massive qualifier, you have to zoom out with Tesla.
Okay, let's look at the 3-year chart.
If you held that same $5,000 for 3 years, you are up 222%. Your $5,000 is worth over $16,000.
That is the difference between trading and investing, isn't it? Tesla moves in these violent bursts.
Exactly. It stagnates for a year, calls it wartime, and then explodes upwards if they solve a hard engineering problem. GM and Ford are compounding steadily right now, while Tesla is coiling for the next big leap, or the next big drop.
So synthesizing this all together, looking at the screener, it feels like the lines are just blurring. We used to have car companies and tech companies.
Now we have GM and Ford becoming energy and software companies that generate cash, and Tesla becoming a robotics company that burns cash to build a future.
It challenges the portfolio strategy. If you want growth in 2026, ironically, you're buying the legacy players for the breakout. If you want a speculative moonshot, you're holding the trillion-dollar incumbent.
It's a complete inversion of the 2021 market logic.
We are going to be watching that Tesla earnings report like hawks tomorrow. If that volatility breaks downward, it could drag the whole sector. If it breaks up, the rotation might flip right back.
It's going to be a wild Wednesday.
That leaves us with a provocative thought. With GM and Ford moving into energy storage and software, and Tesla moving into robotics, are we even looking at car companies anymore, or are these just different types of tech banks with wheels?
Something to think about. Keep watching the charts.